Is gold and silver the next coal?
So, is gold and silver the next coal? Well, before we answer that, let's just cut to a couple of short clips. The recent interview from Gold Seek Radio with Peter Grandich.
Well, I think the first thing regarding the U.S. dollar is that it's better be described as a lesser of two evils. It is in a unique situation in that the euro and European unification has never worked. People are finally facing up to it, and that's one of the reasons that the euro has come off here. And I think all of this will eventually lead to some sort of breakup. Think about Germany, what an absolute economic powerhouse it was 20 or 30 years ago, and now really it is a broken down old former great horse that really needs to be put out in the barn somewhere because it just can't race the way it used to race. And then at the same time, Japan stayed on it, just a suicide mission of cheapening dollars and refusing to recognize what was happening in the world, and thereby destroying their currency along the way. And so the dollar more won on, in a sense, a disqualification because the other players couldn't play versus just, oh my God, it's such a great story and you got to have it. And it's really overextended now too. And so while it has clearly been one of the key reasons that has suppressed the gold price, and of course with that silver, I think much of that is behind it now. And of course, I think when this news hits about the BRICS, I really think the dollar's going to will have reached its all-time high and will start to really deteriorate. In terms of owning, silver and stuff, that's your area of expertise. I'll just say this. I think we can get past the emotions. Americans have been tied up in emotions, the COVID, and then, suddenly you can't afford even gas. And so there's been a lot, and the summer came along, and people just now, for the moment, just went, I'll worry about this in a couple of months. But a couple of months will come, and people will be even worse of shape. But I think if you take a look at the gold market, something that I put out today, and just take a deep breath and realize that it's been in one big trading range. It has traded from about 1650 of its low to about 2000 for its high for almost 3 years. And it's actually part of a much longer and very bullish formation, a cup and handle, and it's now the handle part that's being drawn out in this. And so it's taken a lot of hits. It's never going to be widely accepted in the investment community because they treat it like kryptonite. But with all of this, it's still in a defined trading range and now towards the bottom of that trading range with a lot of bad stuff thrown at it and a lot of bad stuff is kind of behind it, or at least it's peaking. So I would have to tell you that this is one of the very few times for myself where I've been unusually aggressively bullish. I might have been early, but one thing I learned with almost 40 years, and that is I'd rather be a year too early than a day too late. And I just think the gold and silver market now, relative vis-a-vis everything else and compared to where it's been over the years, it's probably one of the better purchases today, looking forward, than really any time that I can remember in my almost 40 years being around them.
So from the Atlantic, the world is turning back to coal, including Germany. And you can see here just how well thermal and even metallurgical coal has done in the last year, or even the last couple of years. Now, I did this video towards the end of 2021 where I had sold my Peabody shares that I bought in late 2020, held them for just over 12 months and sold them for over a 10x gain. So I turned $200,000 into $2 million on this trade on Peabody stock. Also shared, and I've shared in many videos, that I also bought other coal stocks. Some I've trimmed my positions, but I still own those. So I haven't disclosed what those stocks are, but I've said multiple times that I bought one coal stock at 1.8 times earnings. 1.8 times earnings. And that's the thing is Coal has been demonized and hated. You guys want to know what the best performing asset was since the 1990s? Cigarettes. Same thing. Beaten down, bagged, banned from advertising, all that sort of thing. Well, coal was also, and still is, demonized. However, they're bringing coal back, aren't they? And there is now some supply issues with coal, but coal's remaining very elevated. But 1.8 times earnings. I mean, they were giving the company away. Bought another stock that was trading on very cheap multiples as well. And I got paid a dividend. The dividend ended up being a 56% yield on my buy price 12 months later. And in fact, that stock that I bought for 1.8 times earnings, it looks like that's about to pay a dividend for me, and it's going to be a 60% dividend yield on my buy price. And by the way, those other stocks that I haven't sold yet or completely sold yet, they're up 4 and 5 times earnings. 4 and 5 times from when I purchased it. In fact, they're up higher, but they've come back a little bit. But I'll put this video in the description below. If you haven't yet watched it and you're interested, this is what I talk about, and I'll go into more detail in this video. And at the moment, well, you could argue that commodities aren't loved. Everyone's either gone into Bitcoin or big tech or these growth stocks that are trading at 50 times sales. I mean, that's just ridiculous. That's just tulip bubble stuff. And commodities, are still the cheapest asset out there. I'm a value investor. Just listening to Jim Rogers the other day, he also says at the moment, commodities are the only thing that look cheap to him. Bonds are in a bubble, stock market's in a bubble, real estate's in a bubble. Commodities look like the only value out there. And I'll tell you what, if this chart is anything to go by, and look, take it as you will, but if this chart is anything to go by, there's good times ahead for commodities. And I've shared this chart before, but you look at the commodity index versus the S&P 500. And I've talked about in a recent video, the 1973-74. In fact, it was my last video, I think. The 1973-74 recession, how I think that's very likely. Well, look at where the commodity index versus the S&P 500 went to during that time period. And have a look at where it is right now. However, actually, if you look at this year, just this year's performance, the S&P 500 versus gold, well, don't worry. I'm about to do a video on that shortly. You'll see how gold has outperformed the S&P 500. And stay tuned. And speaking of some past videos I did this video, will China dethrone the USA? And I argue no for a whole heap of reasons, but that's not the point why I want to share it in this video. In this video that I did, I also shared why I was shorting a particular stock and a particular commodity. Now, I have sold out of that short position and I made a very nice little profit. Not a huge profit, but a nice little 60% gain on that short position. In fact, the short position was actually up over 100%, but she started going back the other way and I pulled the trigger and took those profits. And I share in here some charts that I've used for a long, long time to both buy leap options, where I see opportunities for stocks, in particular certain commodities, to go up quite quickly. And I also use the same charts when it tells me to short. And so I'll put a link in the description below. I think there's some good lessons in this video, especially about how I look at certain stocks, commodity stocks, and it's different commodities. So I share an oil stock, I share copper, I share iron ore, and a couple others as well for you in this video. So before we talk gold, let's just talk a little bit of macro. So we know the Fed has been raising rates. In fact, most central banks around the world have been raising rates. And, well, we've seen asset prices fall. We've seen stock markets fall. Real estate is starting to fall around the globe in different markets, some more than others. And the big question is, how high a central bank's going to raise? Are they going to bring out the old Taylor rule and go positive rates? Well, I don't think any of us believe that's going to happen, because that will send us all into the greatest depression in history. Sovereigns cannot afford that. Corporates cannot afford that. And households cannot afford positive real rates. So we're going to be left with negative real rates. But the question is, how high do rates go before central banks pause and reverse? Now, I've argued it's not so much the real estate market or the stock market. Perhaps in Australia, the real estate market will be a lot more of concern, simply because banks' balance sheets are leveraged. About 65% of their balance sheet is leveraged to housing, which is about double every other jurisdiction around the world. So our banking system is highly leveraged to real estate. However, I don't believe that they're going to... Look, they want the reverse wealth effect. They want to destroy demand to get CPI down. Now, they can't increase supply by monetary policy. So at some point, they're going to do that. Now, I don't think, as I said, it's whether they've got a target in mind of a 20, 30, 40% fall in this market or that market. I argue that when liquidity dries up, when credit markets start to freeze, when we start to have certain asset classes that go no bid, like in March 2020, central banks at that point will have no choice. They'll pause, they'll inject, and they'll reverse. In fact, from this chart, it's clear that the stock market is following Fed liquidity, both up and down. And with the Fed only beginning QT, we expect to see another $3 trillion come out of the market before that pause and pivot. And it's at that pause and pivot when things get into trouble and people with assets, with counterparty risk, start losing, that there's going to be, in my opinion, a flood into gold in particular, but I think at some point silver as well. But also on the macro, so David Llewellyn-Smith from Macro Business tweeted this out: Australian dollar to fall to 50 cents. So he's on the dollar milkshake bandwagon. Brent Johnson from Santiago Capital says the Aussie dollar's going to sub 40. Sub 40. Now, you guys know, have followed this channel. As part of my portfolio, I've owned US dollars for a little while now because I see a similar trade playing out. And so far, that trade's actually playing out very nicely. Haven't pulled the trigger on that. I don't think I will get to Brent Johnson. If the Aussie dollar does fall to 40 cents, I don't think I will be still in this trade at that point. I think I will pull the trigger in the 50s somewhere and convert that and roll it into what my second part of that plan is for that trade. And while we're speaking of Twitter, Peter Tulip, or should I call him Dr. Peter Tulip? No, whatever. The former senior economist at the Fed and the Reserve Bank of Australia, I just found out last week that he blocked me. Now, I can only imagine that he blocked me because perhaps I reminded him and his followers that weeks out from the Icelandic banking system collapse, he praised it as one of the world's strongest and best banking systems. Guess he didn't like people knowing that. All right, so let's have a look at gold and let's have a look at silver. So, look, no one's investing in gold and silver. We've seen silver in particular see weakness, although it looks like it may have hit its bottom. I certainly hope so. And similar to coal, like I said, coal was, no one liked coal, no one wanted it, dirt cheap. And I see gold, and in particular silver. I think gold's cheap. I think silver's even cheaper. And just on this chart, you look at the divergence between gold and silver. And once again, I look at a chart like this, and it tells me that silver is even more undervalued than gold. Gold is not undervalued compared to silver. Silver is undervalued compared to gold. And as a value investor, I buy things that are cheap, and then I sell things that are high. Now, I own a lot of physical metals, but what I love investing in is the mining space and the juniors and explorer space. And once again, I look at this chart and I see big upside potential in the junior space when compared to the underlying metal. And here's another chart that I've shared before. So to me, there is huge upside. Now, a lot of my explorers had been punished over the last 6 months or so. And I'd shared in previous videos, going back months now, how I had trimmed some of my positions. I took profits off the table. And since then, some of those stocks had been smashed down. Now, I've shared a stock before, and I'll share it right now, Hammer Metals. I've done a video on Hammer Metals, a gold copper explorer in Queensland, Australia, the same state that I live in. And that stock got up to, I bought in at around 3 cents. Stock went up to 12 cents. I took some profits. Well, it was smashed back down to about 3.9 cents. Don't quote me on that. Well, guess what? It's gone on a run again, and it's up almost 9 cents again. And so with Hammer and with a few others, I'd started to go back into the market because they got smashed down. I'll mention another stock that I own, and this isn't financial advice, but Navarre Minerals. They're actually a gold producer now. They were a gold explorer. They're now a producer. They still explore, and I think they've got some wonderful assets and run by wonderful management. And I love their strategy in how they're going about their business. Their stock price peaked at 29 cents back in, I think it was August 2020. They've been beaten down to 4.7 cents or something. Now I've started adding back into that position as well, and they're a bit over 5 cents now. So some of these junior plays, these explorers, now I like the explorers. I'm going to do a video shortly on these explorers because there's certain cycles that they go in. It's very risky investing in this space. Most explorers fail. So, I definitely don't recommend it even to family members. No, I don't recommend anything to anyone, but close family members, I'd tell them, look, so my daughter, for example, get the physical metal. That's the first thing you do. Get the physical metal. From there, you go into the pristine, the pristine gold miners, the big miners, the best miners, the lowest cost producers. Then you might go to the quality mid-tiers. Then you go to the juniors. Then you go to the explorers, the real specky ones. So, and then even within that exploration stage, there's different different lifespans or trying to think of the word, but there's explorers that haven't even started drilling. Or you got explorers that are just starting to drill, report, their drill reports. But then you've got other explorers that have actually found, high grade and large grade assets. So they're different explorers that go along a different path, and so you got to be very, very careful investing in this space. But it's been beaten down. No one wants to invest in this sector. And like coal, when no one wants to invest in it, that's when I go in. When it's dirt cheap, even below its intrinsic value, that's when I go in. Because when they do run, when the underlying metal starts to run, usually the miners and the quality miners severely outperform the actual metal. So you get that leverage on the metal. And silver's the same. In fact, silver, you get that even more leverage. So, I'm loving what's happened with them being beaten down. In fact, these stocks that went up last week were in the office, and even though I'd been adding to them, some of these stocks really jumped up. And, I'm throwing things in the office. I'm like, no. And my business partner's like, what? Like, these damn stocks are going up. He's like, that's a good thing. No, I want to buy more. So, but that's the psychology. I love seeing stocks that I want to buy get smashed down. The market provides me something that I want at an even larger discount. So I've shared these charts before, as I said, so this is that 08 to 11 period. So it's clear. You can see these miners outperform the underlying metal. And silver even more so. And this is what I love. So Saracen in June 2013 was trading at 8 cents. Saracen, by the way, they've merged with Northern Star. So at the time when I did this video, so this is from a previous video, it was trading at $5.96. So a $10,000 investment in 2013 would be $745,000 today, or should I say early 2021. And Northern Star, July 2010, trading at 5 cents. Last year, $14.75 with an all-time high of $15.28 in June 2020. So I recorded this video when it was trading at $14.75. So $10,000 investment in 2010. A decade later, you got nearly $3 million. And another one of my stocks that I shared after I'd sold it was Chalice. That was trading in early 2020 at 17 cents. In fact, it was trading much cheaper than that. I bought it at 17 cents. At the time of the recording of this video, it was trading at $9.06 with an all-time high of $10.48 in November 2021. So a bit over a year I held this stock, and I did invest. Here, so $10,000 investment in 2020 would be $532,000 today, or $616,000 at its all-time high. My $10,000 investment, though, turned into $254,000 when I sold it at $4.33. So yeah, you can have a crack at me for selling too early, but tell you what, I don't know anyone who's gone broke by taking profits. Now, a lot of people say, but Steve, if we go into a recession, we, have all these market crashes and gold's going to be sold off too. Well, like I said, wait, I've got a video coming up soon about that, about how gold has performed this year versus the S&P 500. But if we go to the 1973-74 recession, gold outperformed while stocks fell and we had inflation. Gold outperformed. And even in the Great Depression, 1929, when the stock market fell, we had Homestake Mines posted a 600% gain. Not every gold miner did that, but that's just an example. So, I just buy things that are cheap. I'm a value investor. I buy things that are cheap. The old cigar butt strategy. Nobody wants them. Few puffs left. Well, there's a few more puffs in coal, and there's a lot of puffs left in gold and silver, in my opinion. And, well, they've been beaten down, unloved, and I just have to thank Mr. Market for allowing me to buy these assets at dirt cheap prices. And I think I'm going to be rewarded in the years ahead. You guys know from this video, I think we're in an inflationary decade ahead. A lot due to government policies, especially around energy. And as I say, go have a look at a chart of oil and CPI. I've shared that multiple times. And, well, I think we're going to have high energy prices this decade ahead and relative high CPI. And, well, I think commodities, in my opinion, are the way to go. That's where I've been investing. Once again, not financial advice. Guys, do your own homework. But if you are interested, as I mentioned in a previous video, I am putting together a Finance Uncut Insiders. So if you want more information about that, leave a comment below. But if you like this video, guys, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.